It has started. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story, they are dumping everything. I will show you why they want out, why the political elites are powerless to stop them, and more importantly, why it's going to get much worse. Now let's go to Bloomberg, where we picked today's story up with a headline: foreign direct investment into China slumps to the worst in 30 years as now firms are looking to get their money out of this country. And for China, foreign direct investment is a huge deal. They need money to come into their country in the worst possible way. It's not only from domestic consumption, but when you see money flowing into the country, that means their economy is growing and expanding. The problem is right now is people want out, and in a big way. China's direct investment liabilities and its balance of payments rose by $33 billion last year, now down a whopping 82% from 2022. This measure of the new foreign investment into the country, which records monetary flows connected to foreign-owned entities in China, slumped to the lowest level. You can get this since 1993. What this suggests is everyone believes that China's economy is going to come crashing down. They want to get their money out before it happens. This is a huge problem for Beijing, and as you're going to see, there's literally nothing they can do to stop it. They can prop it up, but their success, well, may not be as easy as it looks. SAFE's data, which gauges net flows, can reflect trends in foreign company profits as well as changes in the size of their operations in China. Profits of foreign industrial firms in China dropped 6.7% last year from the prior year. So here we talk about in the U.S., and we're going to look at more of this later as investors hope for higher and higher profits and bigger earnings. In China, it's in contraction. So this is very notable now. We see the global economy slowing down, and we're having a direct impact on China's industrial base as profits go negative now. The continuing weakness highlights how foreign companies are pulling money out of the country due to geopolitical tensions and higher interest rates elsewhere. So you have two factors here. First, China's economy is just slowing down. People don't want to deal with the administration there. Beijing is just too difficult to deal with. They need to get away from that. You look at other geopolitical issues with the Red Sea. If you're looking to manufacture things right now, you could have it done in China, but it's going to take even longer to get where you needed to. It may actually be cheaper in that regard to go to the U.S. factory sector, which is one of the reasons it's seen a bit of resurgence. But in terms of parking money in China, well, what happens is when you get a divergence in monetary policy, money will flow where the interest rates are lower into countries where interest rates are higher. That is not what China needs. They need to keep money in this country, but there's virtually nothing they can do to stop it because there's a problem if they try to, as you'll soon see. There's rising attractiveness to multinationals of keeping cash overseas rather than China because advanced economies have been raising interest rates while Beijing has been cutting them to stimulate the economy. A recent survey of Japanese firms in China showed that most of these companies cut investment or kept it flat last year, and a majority don't have a positive outlook for 2024, which indicates more money is going to flow out of this country in a major way until Beijing finally steps in and puts a halt to this. How they'll do it, well, that's where it gets interesting. And there are some bright spots. So direct investment in China by German companies reached a record of nearly $12 billion last year. But notably, one of the reasons we'd likely expect this to stop is because money kind of flows in two directions. So Germany uses China as one of its biggest export partners. So when Germany exports to China, what do they get back? They get back money, and then they turn around and they reinvest that money back into the Chinese economy. Everything sort of balances itself out there. But what do we know with Germany's economy? Well, it's in a recession and it's not getting any better. So demand from Germany may plummet. This could be a problem for China if domestic demand doesn't pick up in a meaningful way. And that demonstrates an eagerness to expand the world's #2 economy, while even the European Union steps up scrutiny of these investments because of security concerns. Investment in China as a share of Germany's total direct investment abroad expanded to 10.3% last year, the highest since 2014, course, you might want to look at the other way. That means direct investment from other countries is going down. But does that mean, of course, the Chinese stock market can't rally here? Well, if we looked around the world, what have we noted? That even as economies slow, here we see it in the US, we see it in the European Union, we see it in Japan, markets are rallying, and that means China's market can absolutely go bonkers here. And we gave you the lead on that one. We'll look at this a little bit more, but let's show you these tools that we have in place to help you. Again, another update here on our CTA Timer Pro. And what makes this so unique, and we'll have a full update on Monday, is we look at the machine positioning. Every day we give you a report and we show you now on page 1 when these extreme short positions start to flip. Well, that's the opportunity that you want to take advantage of. I put a whole video out over the weekend, went through all the weekly trades to give you the edge you need. And right now, there are, of course, 3 coupons for a free month. Join it. See if you can make some money, because we know you can. And of course, that makes you a long-term subscriber. Great for all of us as Momentum Timer Pro looks at all those technical signals that many of you try to trade, those RSIs and max Ds. And what happens? You find yourself getting in late and then getting out early. We smooth it out because we also add one extra special thing, our proprietary indicator. Also on October 9th, as many of you know, this all flagged our machine positioning, our Momentum Timer Pro report. It all flagged a buy signal on QQQ. Now again, on page 1, we show you when the 1 month window here is at max, and then momentum starts to flip. It gives you the indicator of where you need to be buying in a big way. And right now, if you followed our program, you'd be up 18.84% on the NASDAQ, and you wouldn't be worried about a whole lot of downside risk just yet, because we'll tell you when the signals flip. But how about China stocks? Well, they're primed for bullish reopen after upbeat data, and that's just a notion here. They are one of the sectors, or one of the ETFs right now, that are very low in value relative to the rest of the world. We picked this up. We've been following on our Sunday show. We showed you how to use our reports to get on that trade. Join that free month. Get your trading pencil out and start sharpening it, because we're going to show you how to make some money. As the early read from Chinese New Year data from holiday hotel sales to Macau visits points to bright spots in services-related industries. A shares should open on a stronger note, continuing the share price recovery on the back of state support. Again, this referring to Chinese stocks traded on the mainland. One thing we note here is that Beijing is putting on a floor underneath the Chinese equity market by trying to buy stocks to prop the market up, to increase domestic demand, give people confidence to come and pour money back into this country. Again, we show you the opportunities before they happen there, and that is already paying off. Because in the short term, national team buying will still be the key factor that supports the Chinese market. In the next 3 to 6 months, it will depend on what target China sets for economic growth and budget deficit this year, suggesting there will likely be more stimulus coming. The question is, can China do this? Well, I started out the show by saying they're powerless. Well, there's a reason why, and it's not what you think. If China holds key rates steady as yuan limits room for PBOC moves, of course, this has many people wondering, why doesn't China just keep cutting rates here? Doesn't that going to stimulate their economy? Well, one of the problems is they have money flowing out of the country. This direct investment from foreigners, well, there's no reason to keep it there. If PBOC keeps lowering rates, meanwhile, everyone's at least raising or keeping rates elevated, you might as well move your money. So that's one reason they can't do it. The second reason is all of these central bankers have this view that they control the currency of their country. Now, we know that's not true, but they think that, and that's true here in China as well. The People's Bank of China held the interest rate onto one-year policy loans at 2.5% on Sunday, while injecting a small amount of cash into the financial system. Both moves in line with expectations among most economists. The move came after the yuan slipped. Here we see it to a 3-month low in offshore trading last week amid a resurgence in the dollar. Now, why would that happen? Because if money's leaving this country, what is it telling people about the currency? Is they don't want it right now. They don't need it. And how does China create demand for its currency? Just like a lot of other places, through an expansion of the global economy, through trade. When people demand the yuan, the value of it appreciates. And that's a challenge here, because I said they're powerless to stop this, and it will likely only get worse because we continue to see trends that the global economy is slowing. And as the world's largest exporter, that is not good news, of course, for Beijing or the PBOC, that at some point is going to be forced to cut the market. We know we'll have a negative reaction to that. As Chinese authorities are in a quandary, on one hand, looser monetary policy can lead to lower funding costs and perhaps spur more economic activity, although we note that China's economy, one of the problems with it, because they're an export-led country, it's not a matter of just lowering rates and then magic happens. In their case, they could lower rates, and if the global economy is still slowing, well, it will have virtually no effect unless it turns domestic consumption around, and that so far hasn't happened. And on the other, if they're trying to avoid depreciation of the yuan as policy diverges with the U.S., and I guarantee you that's absolutely one of the biggest reasons here. They don't want to see the yuan continue to lose value, and they're trying to keep that from happening. That seems to be the number one priority. Sacrifice your economy, but not your currency, where bets on rate cuts by the Federal Reserve are being pushed back as inflation remains sticky. Of course, we've been talking about how the banks here are perhaps going to face a major crisis next month as we get into the end of the Bank Term Funding Program and overnight reverse repo gets near zero. There's a chance that things start to change here in a big way. They could put the Fed back into QE mode. If they do that, well, that means rate cuts are indeed coming. That would give China some margin to lower rates and do some further easing. And while weaker currency may provide a boost for exporters, that would be China, it can also increase the risk of capital flight. Again, that's already a big problem. Money's already leaving the country. You want to give people a reason to accelerate that? Well, go ahead and start cutting rates even more, and they will do this in a big way. But as we talked about, is the issue here is the reason this is going to get worse is the global economy is slowing, and the evidence mounting behind this is getting bigger by the week. As Global Factory Checkup is about to reveal the extent of the nascent recovery, this is going to be a game changer, as we believe that manufacturing activity has trod through and should improve on the back of resilient global growth and the revival of central bank rate cuts in 2024. This from Goldman Sachs. I don't know what this resilient global growth they're referring to is in the hopes of rate cuts. Well, at least according to the Fed and the incoming data, you're looking at third to fourth quarter here. So the notion that the global economy is going to hold together for, say, another 6 months, well, that just seems a little far-fetched, Goldman. Meanwhile, purchasing managers' indices are due this coming week for the UK, Eurozone, and Japan, and while projected to remain in contraction territory. So again, you come back to this whole notion here is that the factory sector around the world is in contraction. That means demand's going down, and the value of currencies are going to reflect that. This is, again, why things for Beijing are going to get worse, because they're trying to hold on to their currency, and in the meantime, they're sacrificing their economy. And they can't continue to do that because they have a property sector that's imploding due to a lack of demand, and that means their banks, who are overly concentrated in loans to the property sector, are insolvent. Beijing's got a lose-lose situation here. They're going to be forced to do something soon. And while still projected here, we see a modest improvement to the February PMIs for the Eurozone and the UK. Modest meaning nothing. They need a big increase because these manufacturing sectors are in an outright recession. Of course, we look at the U.S., we're seeing a little bit of revival here. Again, I think this has a lot to do with what's going on in the Red Sea, and as demand starts to pick up a little bit, there seems to be this focus of why order from overseas when we could just have things done here in the United States, even though it's more costly on the front end. Because there's no shipping delays, it actually saves us money. I think the U.S. economy holds up a little bit longer here, but we'll make the case of why maybe that's not likely to happen over the longer term. Because the COVID pandemic created this big swings in the manufacturing cycle, with the pendulum swinging from a huge boost in goods demand to a subsequent bust. And this is exactly what happens, when you study economic policy throughout the world and history. You find out that these big booms are always followed by big busts. This happens every time. But Look at what they continue to say here. We now believe the pendulum is starting to swing back, supported by a turn in the inventory cycle and moderate improvement in goods demand, suggesting those inventory levels have been worked down. Well, that's not the case. There's a lot of old inventory, way too much old inventory out there. The swing here is mostly in the U.S. data, but that is not going to last at all. I'll show you why on this chart here. As we look at the Philly Fed, this is current general activity for the manufacturing sector. Turned positive last month. The underlying subcomponents weren't as optimistic as the headline number suggests, but we're going to look at this against total compensation, which is average hourly earnings multiplied by average weekly hours of production of non-supervisory employees. We'll put that one in red on a year-over-year rate of change, because what I want to note here is that as total compensation growth slows, what that means is people have less money to deal with higher prices. Demand starts to go down, particularly when you're dealing with high interest rates, high debt service costs, and the hangover from the holidays. Not to mention, the student loan repayments are indeed back. This is all a drag. We noticed that, of course, during the holiday season, it was all led by a debt-fueled expansion to spend in the holidays. Those bills are due, and in a big way. But demand continues to fall because hours worked are getting slashed here. And what we can see is total compensation growth in red slows. Well, there goes the manufacturing sector in the U.S. And you can see how it leads that virtually every time. Now, there are cases where they're in sync, but generally a slowdown in compensation leads to a slowdown in demand, a slowdown in the new orders, and an overall slowdown in the factory sector here. Even though the U.S. has seen some bit of resurgence in the headline number, of course, demand from basically what we see in total compensations going down, that's going to affect China in a big way, because again, we import a lot of stuff from China. And of course, if our consumers here just don't have the money to spend like they used to, that means demand for Chinese goods goes down. It means demand from all over the world continues to head lower. And does this mean that, of course, the U.S. equity rally could come to an end? Oh, it does. As record U.S. stock rally is now under threat from a world in turmoil, and this is a big issue as everyone's piling into U.S. equities. And you kind of make the case here. You see people don't want to keep their money in China because interest rates are higher elsewhere. Well, look at the equity markets. Everybody wants to buy U.S. stocks. It's not just U.S. stocks. They want to buy 7 of them in particular, now dubbed the Magnificent Seven. Everybody wants a piece of that. And lo and behold, everybody owns a piece of that. As expectations for profits at S&P 500 companies for the next 12 months are at record high. Meanwhile, what did we see in China? They're in contraction, suggesting analysts are pricing in a blue sky scenario, with the U.S. economy growing more than expected and the Fed cutting rates, which we know, at least according to the Fed's view, not going to happen at the next few meetings for sure. And if you believe that they're going to cut rates at some point, which we know they likely will, remember, monetary policy works with a lag. It's not instantaneous. So if there's lags on the way up, there's lags on the way down, the Fed could feasibly cut the next meeting and it would have absolutely no effect. But don't tell investors that. They need any excuse to buy at the peak and keep buying even more, as major threat to earnings or signs that inflation is returning. Any sign of that could impact the month-long rally, which has sent the U.S. benchmarks now to record highs. And here we can see that earnings are indeed, looking at corporate profits, and the blue line are lagging. Here we see the Wilshire 5000 price index in red. Wilshire 5000 making new highs as investors are betting and betting big that companies are going to make massive profits. I've noted that indeed here, if the U.S. economy is slowing, what the risk we face here is that companies are not going to hit these numbers unless they lay off a lot of people. You lay off a lot of people, well, that means demand's going to continue to fall down. Maybe you get a one-off last quarter hoorah before you get to ring the bell on the top. It doesn't seem like that's the case, because the geopolitical backdrop is a risk here. If the pressure continues for longer, this could weigh on corporate margins. Bingo, there you have it. Could be inflationary, but we've noted these things generally don't turn out to be inflationary as costs are passed through on price increases. The issue they're saying is the cost could be passed through. We've noted in the case before, when we look at total compensation against the consumer price index, when consumers are not seeing their pay go up enough, they can't afford those higher prices. So if we did see an increase in prices right now, it would be the worst thing. It doesn't mean demand would go up. It means demand's going to further crash. And this kind of scenario is just not in the estimates. No way investors are piling it in a big way. And here you can see, of course, we come back to the U.S. manufacturing sector, one of the biggest headwinds. And this again against the U.S. equity market as well. We need the case in yesterday's show that federal tax receipts have a very strong correlation to the U.S. equity market, and right now are on a trajectory suggesting the U.S. economy is indeed in a contraction while everyone piles in at the top. But here we can see that, of course, when more people get on unemployment, it is a self-licking ice cream cone in this case, my friends. What happens is more people on unemployment, demand goes down, demand from the factory, again, coming back to the Philly Fed Manufacturing Index, against continued claims in red, suggests that this increase in continued claims, which has now gone even higher as of last week's data, suggests that any renaissance in the U.S. manufacturing sector is potentially short-lived, and that where China is going, and that's where we started the show out, they can't stop what's coming. The problem is we can't stop it here in the U.S. either. We are starting to see all the signs we need that the global economy is slipping into recession. And no matter how many rate cuts we get, it won't be enough. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.